Welcome, ladies and gentlemen, to our first set of pre-lecture recordings. Here you will find a number of short videos on different concepts that we'll be covering in this subject. Now, it's really important for you to watch these videos because we're going to be building on this knowledge and going through more advanced content within our seminar classes. So these videos will help you essentially get a good understanding of the foundation of audit and the foundation concepts you need to know before we take these to the next level within our classes. So where do we start? Well, the subject is called Auditing and Assurance Services. So let's start there. Now, our focus this semester will be primarily on audit, and more specifically on the audit of a financial report. But what you need to understand, and what's really important to understand, is that audit is actually only one type of a much broader concept that is assurance. So let's start there. So the definition of an insurance engagement is that it is an engagement in which an assurance practitioner aims to obtain sufficient appropriate evidence in order to express a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party about the outcome of the measurement or evaluation of an underlying subject matter against criteria. Now, I'm not sure about you, but I'm assuming a lot of people are thinking this right now. It's a very long definition and it's not entirely clear. So allow me to try to clarify this for you. Before I do that, there are a couple of concepts or terms within this definition that I want you to focus on. First of all, assurance practitioner. Assurance practitioner refers to the professional who is providing the assurance service. Okay, so in our context, we can think of that assurance practitioner as the auditor. The second concept I want you to focus on is conclusion. At the end of the assurance process, the assurance practitioner would express a conclusion or an opinion about the information that they have checked. Next one, we're going to jump a little bit. Information that they have checked. Ladies and gentlemen, that's called the subject matter. The subject matter refers to whatever content or whatever material it is that the assurance practitioner is indeed checking. So the subject matter is essentially the information being checked. Now that information is prepared by someone. That someone or that group is called the responsible party. So if you want, in your notes, I would write down the word preparer. Next to the term responsible party, write down preparer, because the responsible party is the party that prepares the information that we are checking. Remember, the information that we are checking is called the subject matter. Now that information is being prepared for certain people. It's to be used by certain individuals. Those individuals are called the intended users. Finally, and don't worry, I will bring this all together, but I just wanted to highlight these terms. Finally, when an assurance practitioner, such as an auditor, when we check information, we need to have a set of rules in order to guide us as to whether that information is indeed right or wrong. Those set of rules that we use to guide us, ladies and gentlemen, are called the criteria. So to summarize, the assurance practitioner is the individual that is providing the assurance service. They are the ones that are coming in and checking certain information. The information being checked is called the subject matter. The subject matter was prepared by the responsible party. They are the preparers of the information. The assurance practitioner, when they come in to check this information, they do so against a set of criteria that helps them to determine whether that information is indeed right or wrong. Once we check the subject matter against the criteria, we come up with a conclusion. We come up with an opinion as to whether that information is indeed complying with the criteria or not. Now let's put this into the context that we'll be talking about this semester. And the focus of our semester will be on the audit of a financial report. So that's going to be our context. So let's focus on that. Now, something to be very clear about before we go any further is what we are talking about when we refer to the audit of a financial report. Now, often students think that when we audit a financial report, we are simply looking at and checking the numbers in the income statement, the numbers in the balance sheet, the numbers in the cash flow statement, and so on. Now, I want to be very clear here. Yes, we do audit the numbers within the financial statements, but that's not all we look at. When we refer to the audit of a financial report, we're not only auditing the financial statements and the information within those, we're also auditing the written disclosures as well, the notes that accompany the financial statements. So just be mindful of that. It's not just the numbers, it's also the written words as well. Now, that's the context in which we focus on. We're auditing the information within the financial report. So that's our subject matter. That's the information that we are evaluating. So who are the people that prepare this information? That's the company management and directors. They are the personnel responsible for preparing the financial report. Now remember what we call the personnel responsible for preparing the information. They are the responsible party. Okay, so management and directors are the responsible party who are the personnel who prepare the financial report, which is the subject matter. So we as the auditors, we are the assurance practitioner. We come in and we evaluate the information within the financial report. We evaluate it, we collect evidence, we perform testing in an attempt, to determine whether the information within the financial report is indeed true and fair or not. Now, what does that mean? We're trying to determine whether the information presented is indeed a true reflection of the business. It's a true representation of what has taken place in that organization. In order to determine whether that information is indeed true and fair or not, we need a set of rules to guide us. We need a set of criteria. Now that comes in the form of the accounting standards. They are the criteria that we as the auditors use in order to evaluate whether the financial statements and the notes are indeed true and fair or not. So once we've performed our audit, we've collected all of our evidence, and we've evaluated our findings, we express a conclusion. Now, the conclusion is called the audit opinion, and the audit opinion is included within a written report called the audit report. So we'll talk about the different types of audit reports in a separate video, but essentially that's where we present our conclusion. So the final piece of the puzzle, why do we prepare this information? Why do we actually need to check the financial report? Why do we need to express a conclusion? The reason is there are people who rely on this information, people who need this information in order to make decisions. In this context, those intended users of this information are indeed the company shareholders. They are the personnel that will rely on the financial report and the audit report in order to make decisions based on the conclusions provided. So essentially, the auditor is the assurance practitioner. They come in and they evaluate or check the subject matter against criteria to prepare a conclusion or determine an opinion about whether that information is indeed true and fair or not. And they do that in order to assist the users, the intended users of the information. Okay, so we have the responsible party, the subject matter, the criteria we use, the assurance practitioner, the conclusion that is aimed to enhance the understanding of the shareholders. So essentially, an assurance engagement will have 5 key elements. There's a 3-party relationship between the assurance practitioner, which is the auditor, the responsible party, who are the preparers of the information, as well as the intended user, which in our case is the shareholder. There will be an underlying subject matter, information that is being checked by the assurance practitioner. They will be checking that information against a set of criteria. They will collect evidence as part of the process in order to evaluate whether that information is indeed true or not. And they will express an opinion within a written assurance report, which in our case was the audit report. As I said earlier, audits are only one type of a much broader concept that is assurance. There are other types of assurance engagements as well, such as reviews. Now, a review is very similar to an audit, but it's just less comprehensive. It's not as detailed and doesn't require as much work as an audit, but it's still an assurance engagement where we provide an opinion at the end of the engagement. Other engagements that also sit under assurance include things such as environmental assurance, and that is when we provide assurance or we provide an opinion regarding things like carbon dioxide emissions within a company. Now, there's also another category called non-assurance services. And the key difference between assurance and non-assurance is in assurance engagements, we provide an opinion. We provide a conclusion at the end of the engagement. The difference with non-assurance is there is no such conclusion. There is no such opinion. Rather, we are simply performing a task on behalf of the client. And that's why it's called agreed upon procedures. So certain engagements whereby we do things like bookkeeping, or we complete the tax return of the client, or we simply do some consulting work for them, in those types of engagements, we are not really checking information that has been prepared to criteria and providing a conclusion. Rather, we are simply performing a task on behalf of the client. We are simply completing their tax return, or we're simply completing their accounting records for them. So that's the difference between assurance and non-assurance. And as I said earlier, our focus will be on audits, and particularly the audit of a financial report. The final thing to talk about are the different levels of assurance. Now, the highest level of assurance we provide is provided when it comes to audit, and that's called reasonable assurance. Now, I want you to think about that word for a moment. Reasonable assurance. That's not absolute assurance, and it's not guaranteed assurance. Why is that? Because, ladies and gentlemen, believe it or not, there's no such thing as absolute assurance. Why? Because there are limitations when it comes to an audit. Just for a moment, think about these three businesses: McDonald's, IKEA, Coles. Can you think about testing the sales within those organizations? Think about the sheer volume of sales transactions they have on a daily basis. It would be impossible for us to test every single transaction. And that is why, as part of an audit, we often take a sample. We take a sample of transactions and we test those. And we use those conclusions to help us reach our ultimate conclusion and our ultimate opinion. That is why the highest level of assurance is called reasonable, not absolute and not guaranteed. And that's associated with an audit. The second level, when you come down one level, is called limited assurance. Now, limited assurance is provided when we do review engagements. Remember what we said earlier. A review is very similar to an audit, but it's less comprehensive. And that's why we provide a lower level of assurance called limited or moderate assurance. The final level is no assurance. No assurance is when we're not actually checking information against criteria, rather we're just performing tasks on behalf of the client. We talked about this earlier, and that's called agreed upon procedures. So these are really important concepts for you to know. The final thing I want to highlight before I let you go is this note over here. Just remember that all public companies must have their financial report audited at least annually. So this is referring to all public companies, meaning those listed on the ASX. They are legally required to have an audit at least once every year. Okay? Well done on getting through our first video. If you do have any questions, please do let me know. Otherwise, please move on to the next video. Have a great day and see you later.